We're now going to talk about prioritizing resilience and innovation in the economy and financial services. We're going to kind of widen the lens a little bit to talk about, to have a pan-European perspective, but we'll also obviously address developments in this region too. So let me introduce our speakers, 4 speakers to join me on the stage. Miljan Zdrale from the European Bank for Reconstruction and Development. Welcome, sir, and have a seat. Cheers. Martin Bijsterbosch, Deputy Head of the Euro Area External Sector Division at the European Central Bank. Welcome again, Martin, nice to see you. Colin Ellis from Moody's Investor Services. Welcome, Colin. And Hana, Huzjak, Economic Counsellor, Reform and Investment Task Force at the European Commission. Welcome, Hana. Okay, have a seat. Okay. So we have about 35, 40 minutes for this session, and I'm sure our panelists are going to pick up on things that they've heard earlier in the day this morning. Let's have some brief intros from all of them, then we'll have a discussion. Clock's here so you can see how much time you've got, and yeah, if we can keep it snappy in the beginning, we can have more Q&A. So over to you, Miljan.
Thank you, and thanks again for having me. And it's really great to see still people being committed. So it's always not it's value, not the volume. And since Europe cannot compete at cost, but has to compete at the value, I would like to just reflect on a couple of points. Many things have been said this morning and throughout the day, and I will just reflect also through that on Croatia and also what our institution is doing. Obviously, we are all facing, as we saw this morning, softening external demand, manufacturing pressure, particularly from China, where 25% of the manufacturing output is coming these days. Put it together more than, or in terms of exports, more than US and Germany combined. And then we have obviously impact on demographic change. We all can see it in Croatia in the numbers, not only declining numbers, but also in particular in terms of the aging of the population. Irrespective of that, as Prime Minister mentioned this morning, Croatia, Czech Republic, Poland, and Lithuania, they have been performing much better than some of the other emerging markets in Europe, thanks to obviously real wage growth, which has its own flip side, but we'll leave that for a moment. Obviously, there has been investment also rebound and stronger domestic demand. But this brings me basically to the point of your panel, which is what reforms are needed. And I think there are plenty of things that has been done well in terms of the economic integration. Obviously, somebody said this morning it was within hard and rock place between China and US. This is inevitable, and I think this is probably happening, but slower than it should be. And same goes for the energy transition, given everything what is happening with the current conflict in Ukraine. So, having said that, I think for us it's really about going further into the streamlining the administration. We still have EU countries which have different rules, different bankruptcies, procedures, etc., and let alone capital markets. I'm mentioning capital markets because these are particularly Central and Southeast European countries are very much bank-centric, and with all due respect to the banking sector, which is important, you cannot have innovation and R&D in particular. Just one data, I think US is more than 270 billion euro investments in R&D, more than Europe together. So that tells you all in terms of the new technologies and advancements, and I think only which one is standing out is actually Swiss. So I think capital markets is number one. SOE is very much still dominant in public sector, particularly in our region, and including Croatia. I think this is where efficiencies and improvements in the governance, and this is one of the enablers that in our strategy is really to help advanced countries such as Croatia. And capital markets, as I said, we are working together, and this is a really daunting challenge, having 8 regional stock exchanges to become maybe one common investment spot. Let's see whether we will manage. There is strong commitment also by Croatian government. I would like to applaud them for that, in particular Ministry of Finance. EBRD, regional stock exchanges, but it's not only about Croatia, it's joint effort by Poland, Romania, and 8 countries. I'm sorry for not mentioning all of them, but they know. And I think that's really something which is go hands in hand with this savings and investment union, because this is, if you want to have venture capital, if you want to have scaling up of the new technologies, this is number one to have. Poland, Warsaw Stock Exchange, it's big enough on its own. I'm not talking about Frankfurt or London in particular, but then we are like, and Bucharest has been more alive, including Zagreb. But I think this is something to be worked on. The demographic challenge is very important, and as if somebody saw our transition report, which just was published, you know, the change in demographics, Croatia has 22% plus, and it goes pretty much for all the countries above 60 plus. This is very costly, but this is also impacting the availability of the labor force, and that can shave off 0.36 based on economists from the GDP through 250. And I think to respond to that, you have to have targeted immigration, but nobody can afford a 1% net immigration flow. I think other things have to be done in terms of the really working on the skilling of the people, working on the childcare, working on the institutions, but targeted immigration, but more importantly, ANI, the new technologies and digitalization in order to improve the productivity. And then that brings me, before I conclude, we can go more granular into the next stage, what financial instruments, obviously public financing are under strain. We saw that Germany as the biggest economy, what is now happening, that public spending are going up, investments are going down, and the fiscal deficits are widening. So you cannot afford any longer without mobilizing private sector and private resources. If you want to do accelerated digitalization, innovation, energy transition, not only energy transition, energy dependence in terms of new technologies. These days we have in Europe energy 2-3 times more expensive than US. Industrial upgrading, as I said at the beginning, EU cannot compete at the cost. It has to compete on technology, reliability, because we are where we are in terms of the logistics, and adding value. So, and I will pause here. These are just food for thoughts. We can go more granular in the next round in terms of some of the data and what is really prompting. And I think this is the last call. We heard this morning some of the potential solutions, but I think that they have to be really multidisciplinary and multi-sector and in much more coordinated manner than what they are today. Thank you.
Okay, thank you very much, Miljan. Martin, over to you.
Thank you very much, and thanks for the invitation. It's a pleasure to be here. So I want to start with the pan-European picture, and I want to focus on the competitiveness, trade challenges that we have. Let me make 3 quick points. So first point will be on the challenge, second point will be on resilience, and the third point will be on the way forward. Now, I think the challenge is relatively well understood. It's been extensively discussed. I just want to highlight one aspect of that challenge because it connects to the way forward that I want to emphasize. So that challenge, I think, stems from the fact that Europe has built its growth model on an export-led strategy, and that has changed. We have external shocks. We have the change in the geopolitical environment. We have, well-known competitiveness problems, and so I think that strategy has paid off, but doesn't work anymore. And just to illustrate that challenge, we go back to the beginning of 2023. We were forecasting export growth, European export growth, to be around 8% in cumulative terms until the middle of this year. When you look back, exports have not grown at all. So that's, I think, a very strong illustration that something is going on there. And it's not the lack of, say, global trade growth. It's really the inability of Europe to make use of that global trade growth. Second point, resilience. Now, I do want to add some nuance to the gloomy perception of Europe, because there are also sources of strength despite that external weakness that I've mentioned. There's been remarkable domestic resilience in the European economy. If you look at the labor market, for example, the labor market has defied historical trends. Traditionally, employment growth is around half of, say, output growth, of real GDP growth. But what we've seen since the beginning of the pandemic is that elasticity has increased. We're now seeing something that is closer to, a one-to-one relationship between employment and GDP. And that is not just labor hoarding. I think there are changes in the European labor market that, that are a sign of strength. And that strong labor market also enabled us to, has also enabled households to increase their spending. So it has created a virtuous cycle of job creation and in turn fueling spending and especially the growth in the labor-intensive sectors. Second point I want to make, another illustration of the kind of the resilience the European economy has shown, and I think it's an element that is underappreciated, which is the shift towards digital investment. When you look at intangible investment, so investment in AI, cloud solutions, digital infrastructure, that investment is actually surging in Europe. When you look at the data, you'll see that cumulative growth in intangible investment since the beginning of 2022 has been around 12%. That may not be as strong as elsewhere, but it is clearly there, and I think it shows that also firms' recognition that digital transformation is essential for competitiveness. Third point. Resilience clearly may be there, but it's not enough to address Europe's growth challenge. That's very clear. So if we want to move from resilience to strength, we must unlock the full potential of the single market. It has been said before, but it is really crucial, especially in services and finance. Despite 3 decades of progress, that intra-EU trade, that process has stagnated, and the barriers remain stubbornly high. Now we will have some new analysis coming out soon that illustrates that those barriers, and we will show that when you kind of measure those or express those barriers in terms of tariffs, that those barriers for intra-EU trade for services amount to something like 100%, and for goods they amount to something like 65%. They may sound familiar, those numbers, because the IMF has also done similar work, and those numbers have also been widely quoted. We go further than that. We add a number of things to that analysis, but I don't have time to elaborate on that right now. Now, I think one has to be very careful with those numbers because they really represent, say, theoretical upper bounds of, say, the potential trade that is there. They also reflect differences in preference, for example, across countries, right? I mean, German households are less likely to drive French cars and vice versa. Italian consumers don't really drink Spanish wine and vice versa. So those things, of course, one cannot change by implementing the single market. But what the key point here is that there is a lot of potential there, and a relatively limited decline in intra-EU trade barriers can offset the impact of the higher US tariffs. So what concretely needs to be done? I think there are 4 things. I won't elaborate on them, but I'll just mention them here. So the first thing is reviving mutual recognition of standards. Second thing is streamlined decision-making through more qualified majority voting. And the third thing is the 28th regime. Now, I think there are encouraging signals here that things are moving. But my key point is really the European economy has shown resilience, but to address its growth challenge, we need to go beyond that. We need to really implement the single market, and that's not only crucial, but I think it's also feasible. Thank you.
Thank you very much, Martin. Colin?
Thank you very much, Joan, and good afternoon, everybody. I'm sure the rest of the panel would echo me when I say thank you for coming back after lunch. There was a lot that was packed in earlier today, and I think a challenge for us here today is to shift the debate maybe a little bit towards particularly the finance sector, because the topic of this session is prioritizing resilience and innovation with that focus on economics and finance. And I do want to start by acknowledging a lot of the progress that's been made in Europe, and particularly here in Croatia and in the region. If you look at the progress over the past 10 years, or more broadly since the global financial crisis, I think we have succeeded in building in a lot more resilience. And I think you can see that in terms of bank capitalization and liquidity measures. You can see that in terms of our ratings. You can also see that in terms of many of the sovereigns that we rate. You know, often for us, the country rating will be a benchmark against which many other ratings, whether they're for banks or corporates or something else, will be judged. And last year, 2025, was one of the very few years where we have upgraded more sovereigns than we have downgraded them. It's a net positive upgrade. And that's true in Europe as well, where we've seen substantial progress from some of those countries that came under pressure, particularly in the wake of the global financial crisis. But also places like here in Croatia. Just 3 years ago, you know, in 2022, Croatia was a non-investment grade credit. And we now rate it as an A3 with a stable rating. That's a very strong rating for this country. So there has been substantial progress, particularly around the core elements of the financial system, which is banks in Europe, but also on sovereign debt balance sheets. We can come back and talk about France if you'd like, Joan, but I'll skip over it for now. I also want to acknowledge that some of the European policies, particularly like the RRF, have made a tangible difference. When you look at the efforts to bolster capacity and replace the electricity network here in Croatia, that's a substantial long-term benefit that will be paying out for a very long time to come. But that's where my question marks start to kind of crop up as well, because for those of you that were here last year or have seen me before, one of the big questions for us around RRF and the broader Next Gen EU program wasn't just about how much growth do you get when you're spending the money. It was about how much growth do you get when you stop spending the money, or what happens to your potential growth rate. Will GDP growth be faster 5 years from now because of the investments you've made? And I'm a little bit more optimistic in places like this, where I think a lot of governments have taken advantage both of the grant and loan options, and it's gone into infrastructure and productive capacity. I'm a little bit less optimistic in some other parts of Europe, if I'm honest. But the broader thing I wanted to come on to was actually the second part of the title. So the title of this panel is focused on resilience, yes, but also innovation. And that's where I think we need to be really careful, because we still have this focus on shoring up what we have. We have a bit of a focus on can we find more money to do more things. But innovation is not about funding by itself. It's also about having the courage to change. It's about having the courage to do something different. It's about recognizing that financial stability is not about avoiding anything going wrong. It's not about avoiding any bank or any investment losing money. It's about making the system as a whole resilient to those instances. And that perspective is absolutely critical, because if you believe that governments cannot fund everything by themselves, you have to get private sector money in there as well. And if you believe private sector money is important, you have to believe in the freedom to lose money. And that's where we get in some really difficult conversations about things like adaptive policies, where you're not relying on precise legalistic interpretations, but you have regulators and policymakers who can respond to the changing nature of shocks. That's where you get into conversations about incentives to help people take risk-taking seriously. And it's also where you get into cultural questions, where people are happy not just to sit all of their savings in the banks, but they're willing to risk them a bit more and take bets that may not pay off in the longer term. And we know you can do this because there are parts of the EU, like Sweden, that have done this very successfully. But it's a long-term plan, it's a long-term program. And without those in place, those elements in place, I'm not sure we'll ever really get to the grips of the innovation challenge that the EU faces.
Excellent, thank you very much, Colin. And last but not least, Hana.
Yeah, thank you, and good afternoon. I think I'll follow up a little bit on the point that Colin made, and I'll try to give a little bit of a overview of where we stand in terms of the great expectations from the Recovery and the Resilience Facility. Of course, I think the mandate, when it was launched as a post-recovery instrument with a huge amount of 650 billion euros, is it is it actually delivering, and what is the status on the ground so far? So I think if you've, and I think many people here in the room are in Croatia, and I think if you follow the news, of course, the key question is always that we hear is the absorption. How much money of the 10 billion euros has Croatia absorbed? Yes, I have to say the implementation is going well. In Croatia, only two days ago, actually, the Commission gave a positive preliminary assessment for the 7th payment request, so like a 7th tranche of the facility out of the 10 that is being planned. So the implementation is going well. It has also picked up the implementation in all the other member states as well. So I would say it's on track. It needs to accelerate, but why is it important? It's important to say, okay, yes, the money is flowing, the money is reaching the economy, and unlike in cases of some of the previous crises, the public investment has been maintained. In Europe, this is also something that was one of the engines of the growth. But when we speak about the RRF, I think we also have to keep in mind that the RRF, as it was envisaged, is much more than just a budgetary injection. It's not only injection of money in the state budgets and you spend, and this would be the only way basically to contribute to growth. There's two important things that I would like to say. First one is it's not only at the country level about the direct effect. So for example, for Croatia, yes, Croatia will benefit from 10 billion euros. If we look at the whole of the European Union, these type of national allocations for the budgets are so-called direct effects, but there's also a lot of indirect effects or the spillover effects for the overall economy in which we look at, and it's actually really good outcome so far, how much the RRF has contributed in terms of the cross-border, let's say, cooperation, or actually boosting the investments, the equipment, which is being delivered from one country to another. We've done a very detailed analysis of that on a number of countries, including Germany, including Austria, including Slovenia, quite a few. Unfortunately, not for Croatia yet. But what we see is actually that out of overall RRF impacts in the EU, 40% is actually these indirect spillover effects from imported goods and services from other countries. And I think it's important to underline, I think it's not as tangible as we see the money flowing in the budget, but I think this is actually one of the value added of this type of an instrument that is EU-wide with a very specific mandate. And I think also shows the contribution of the single market, even though, of course, there's room for improvement on that. The second point that I also want to underline, again, it's not only about the money. One of the key elements of the RRF was this package of reforms and investment that had to go hand in hand, and this is also how all of the recovery plans were designed. A quarter of all of these investments was actually, what we look at the plans, is went for the quality of the institutions, so reforms of the public administration, judiciary, anti-corruption, so these are all of the elements that we need as a base in terms of growth and innovation and everything else that goes in that. Around 17% of these reforms are for business environments, so simplification, cutting red tape, digitalization. Of course, there were a number of reforms in terms of the labor market, the skills. So yes, these were in plans, but I think what I really want to underline here is one, they've already taken place. They were front-loaded. So many of these reforms actually took place at the very beginning of the implementation of the facility, which means that they create good conditions for implementation of the investments, not only from the RRF, but also cohesion funding and the national funds as well. And the second one is that we see, in terms of the priority investments, you will know in terms of the European semester that we issue with the Council country-specific recommendations. And with the RRF, only in the last few years, we see that the reforms of these country-specific recommendations have increased by 17 percentage points. So this is only in a matter of a few years to show and to account for the positive, to ensure that actually the reforms which are tough, I think we shouldn't also forget that reforms are difficult. They required a lot of time, they require a lot of political capital, and this is why I think also the RRF gives a contribution to do some of these difficult decisions and to ensure that there's a good environment and the framework to implement the investments as well. I'll just say, and maybe a quick comment to the point of the concern whether there will be growth when the money is spent. In terms of, yeah, maybe how should I say this? There will be, okay. What we calculate right now, it's very difficult to account both for investments and the reforms. Investments are very tangible. So for example, the next year, we see that the European GDP might increase up until 1.4, maybe percentage points with the RF than it would have been in the no-case scenario. This is, of course, assuming full implementation. But also some of the analysis, including by the ECB, these 1.4 it's only investments. So it's actually an underestimation of all of the reforms that will take place. And the impact of these reforms will actually be more in the medium and the longer term. So what we see is that even when the RF is done next year, up until 2032, 2033, an additional 1 point of the GDP will be a result of the reforms which are taking place now. So it's very difficult to quantify, but these are the projections, some of the Commission, some of the ECB. And I have to again say, provided that the recovery plans as they stand right now are implemented in full. And the deadlines are very tight, end of August next year. So we'll see.
Thank you very much, Hana. So thanks very much, all of you. We've got about 10 minutes, a bit more, a bit over 10 minutes. Time flies. Just wanted to check, this is a test, if everybody's awake after their lunch. Any questions from the floor, giving you a chance just to ask a question to our panel? If there's anything obvious that occurs to you? If not, I will interrogate them. Well, not quite. Just to, I agree that the focus of the discussion, should shift to the financial sector, because we've not talked about it too much now, and the single market in the financial sector, which of course Enrico Letta talked about this morning. So just before that, I just wanted to ask, because we haven't really spoken, we usually do at these events, we usually have finance ministers and so on, and we start speaking about fiscal deficits and public debt and so on. So don't want to ignore that, because while some of those issues have been addressed in some countries, obviously in some of the leading countries in the region, it's very much an issue that is to the fore. So I just wanted to ask you how you see that, and how much of a constraint that might be on doing some of the things that we're talking about here. Do you see much prospect of fiscal consolidation and bringing down the public debt, and is that in the next few years? Maybe Colin, I should ask you about this one.
Sure. I mean, we do look at deficits and debt quite a lot, obviously. I think our outlook for Europe as a whole hasn't really shifted much in aggregate over the past probably 12 to 18 months, where we see pockets of progress, and that's where I talked about some of the upgrades. We now have Slovakia, Spain, Portugal, Croatia are all A3 credits. That's a really good rating. And where you look at where they've come from over the past 10 years, the progress there is amazing. Greece is back in investment grade. We've seen progress. We've seen a lot of progress. And what matters for us is not just what's happening to the deficit and what's happening to the debt, but in essence, we're also trying to look forward so that if there was an issue, do we trust the governments involved to take the necessary steps to address those kind of issues? If there was a debt sustainability problem, would you see a policy response? We tend to call that institutional strength and governance when we think about sovereign ratings. And the big place where we're talking about that a lot right now is, of course, France. We still have a AA3 rating on France. It has a negative outlook, which means historically there's about a 1 in 3, maybe a 1 in 2 chance of a downgrade. But in essence, that is driven by our concerns about the ability of the authorities to implement policies to bring debt dynamics under control. And we also downgraded another small country this year called the United States of America, which was a very popular thing to do for very similar reasons. Institutional strength, the ability of institutions and politicians that form governments to take the steps they need to take in order to address debt issues is incredibly important for us. And in some of these big countries like France, like the US, maybe even we could talk a bit about the UK, it's a little bit untested. And it's only really now we're testing it. Whereas when you look at Greece, Portugal, Spain, those countries that went through the crisis, it has been tested. And sometimes it was a bit bumpy, but they were able to pursue not just kind of structural reforms to liberate the economy, but actual outright fiscal reforms, spending cuts and taxation rises to bring debt dynamics under control. And I think if you look back at the kind of broader group of advanced economies, those that have made a lot of progress over the past 10, 12 years on debt reduction have something of a bit of a history of going through these problems. You're talking about Iceland, you're talking about Ireland, you're talking about the countries I've just mentioned. I'm not sure we've seen the same trigger to the same degree that's focused minds and built a constituency for sound public finances in the US or in France or in the UK. Frankly, I mean, I really hope Liz Truss did it, but I don't think she did. I don't think there is a broad agreement and recognition among voters that sound public finances are a concern. And so we have a slight dichotomy where I can point to pockets of real progress, but there are also some big risks out there which may take a long time to fully crystallize.
Yeah. And you were actually talking quite a lot about risk-taking
I was.
at the end of your introduction, which is not something the EU is generally known for in that respect. So encouraging, in fact, on the contrary, risk aversion seems to be the kind of dominant, leitmotif, if you like, in the EU. So I guess I want to ask the others what they what they think about that. But first of all, just coming back to the single market question, and obviously, Martin, you focused on that a lot. So what did you take from Enrico Letta when he was speaking earlier? And, we've got this deadline now of 2028 to complete these 3 verticals, of establishing single market in finance, in energy, in digital tech, and so on. You talked about a few things that could start to make that happen to unblock the full potential. So streamlined voting, majority voting, and revising, all this kind of regulatory mess. What else? I mean, and are you optimistic that this can happen by that deadline?
Well, I think that what we heard this morning is encouraging. I think that there are clearly, the initiatives are there. The Commission is working hard on it. So I think that that's encouraging what we heard this morning. In the end, it will be up to the member states, right? So it will be up to political will of the member states, and that's where the issue is. But given that the Council agreed, on that strategy, I think that that's an encouraging sign. So I'm cautiously optimistic that will make progress. That we'll see further progress on that.
Yeah. I may ask the others as well, Hana and you, what's your view, Miljan?
I mean,
this is your field in a way.
Indeed, and I think what has been said, a lot of progress has been made up to now, particularly because we are in Croatia, and I'm responsible for this part of Central Europe, particularly Croatia. I think if you look at how even though maybe these days EU doesn't look like an easy place to be, it has meant a lot, particularly for this country. If you look at convergence into the national income, if you look at stability, if you look at investment rating, macros, labor market, banking. I mean, I have a colleague here responsible for financial institution. 10 years ago, you could not even raise M&A, let alone go into some R&D financing. It was like maximum, you pull a couple of banks, you get 200-300 million euros. Today, we have very much well-capitalized banking sector, which is a key pillar. Lowest NPL, I think, probably in Croatian history since independence. So this helped, and we have ECB as a common regulator. we have major international banks. Now, how do you move forward when you are now having, on one side, we are not immune, obviously, given that Germany and France as two engines are in what situation what we are now. We have average tariffs being raised by the states, and we have what was said today on the US, on the China side, where there is really pressure. We see it when we want every single renewable energy project we finance today, irrespective whether it's of every part of the hardware is coming from China, and we see. So I think from now, what do we do? There is not enough. I mean, we have great with the European Commission on InvestEU, risk mitigants. I think what we need to be more clever is really you cannot have even one. Let's say Zagreb and Ljubljana stock exchanges, they have diverging rules. So we have capital markets has to be, number one priority in any sense. I think progress has been made in terms of the private equity, where there is a lot of European money being poured into it, including ourselves, institutional investors and retail investors. Let's face it, there is a lot of retail investors' money that has not been utilized. I think this is something, if you really want to step up in terms of the, but for that, if I want to, as an e-citizen, click on my app and put some money into 3 IPOs that happened this year in Croatia, I would like to do that also when the Romanian SME is going public. I think this is, and then the last thing, which is even more challenging, is the venture capital. I looked at the data on the unicorns. This country had 2 unicorns, but there are 1,400 unicorns globally. Maybe, I don't know, well, I'm just maybe sorry if I make mistakes, probably 2 or 3 quarters are overseas. And in our region, we have, in our region, compared with other regions, we have only 2, and 2 are in Croatia. We can be proud of that. But without those, going really capillary in terms of the accepting, and we have a population where it's a political now debate. First of all, you cannot just even do target immigration because nobody politically or socially will accept it institutionally. But we need to, how you're gonna innovate and digitalize and autonomize SMEs without having right financing tools. And I think that's, to me, that's the challenge number 1. We as institutional play a role because we are very much private sector focused. And I think if we manage to do on the capital markets and on the venture capital funds, the same success what has been done on the banking, core banking sector, I think we are on the right path to tackle these 2, to support and accelerate energy and digital pillars. Otherwise, I don't think so we can do it with the public money, and irrespective of how much money you will put, because simply you have public financing, except for few examples, including Croatia, worsening. And now, in terms of the real wages growth, these are non-discretionary items. So then you are even becoming much more vulnerable. So relying on the public sector money is really not an option. So.
Okay, so let's talk about that, the financial instruments and mobilizing private investment. I mean, is there appetite really for regional stock exchange? Is that a good way forward or not? Is it a non-starter? What do people think? Hana, did you want to come in on this?
Maybe not specifically on this, because as you know, this is under discussion, this particular one. But I would just agree in terms of, I think there's an awareness of the benefits of a higher integration, and I think we're finally discussing some topics which were untouchable. As during the COVID, it was never discussed whether, or it was seen impossible that the EU would have a common debt. We have it, and we raised it. It was done in the end fairly quickly. In the same way as it was said, I think now we're having a discussion how to integrate more in the single market, the capital markets union, the savings and investment union, and I think we still have a long way to go, but this is the type of the discussions that we need to have and are having already. So this is why, just to underline also the optimism from my end.
Yeah. Martin, did you want to go on?
I think we have to start with the savings side first. We know we have fast savings.
Yeah.
We have fast savings in Europe, but we know that most of those household savings end up in the banking system, right? So we know that 1/3 of the financial assets of European households are held in deposits and cash, and that number is something like
or real estate like here, and then you have unaffordable housing, and you cannot retain the talent, let alone attract it.
So much more in the banking system than in the US, right? So, and that is because of, it's expensive, it's opaque, and I think that's the starting point. For example, by putting more emphasis on developing funded pension systems is one way to develop that. So, and then we come at the second stage, which is getting out of that home bias and channeling those savings across Europe. And we know that 60% of household investment, those that do invest, that 60% they invest in their home country in Europe. So that's definitely a second issue, and that relates to the issues I've mentioned about 28th regime, mutual recognition, about the capital markets union. And then of course we have the final phase of that, which has to do with do those funds reach the small companies that need the funding? So there are three phases here, and I think you need to talk about all three of them to really to establish that mechanism throughout Europe.
Yeah, I'm going to got the last 20 seconds, 20 seconds, Colin, to maybe talk more about risk taking and.
Okay. I mean, I'm not allowed to give policy advice, so I'll try and phrase this quite carefully. But here's one example of a risk. If all of this happens and we get a pan-European capital markets union, that's wonderful. And as a relatively small EU country like Croatia, you have a choice. You can wait for that. Or you can do things like pension reform, and you can do things like retail investment accounts, and you can do things like restructure your insolvency process. I'm a credit guy at the end of the day, right? That's a critical part of all of this stuff. Mm-hmm. And you can do all of that now, right here. Because Sweden didn't wait for the rest of the EU to establish deep domestic capital markets. It would be great if that happened at the European level, but it's not a requirement. You have a choice as policymakers of whether you try and do what you can within your own sphere first.
Thanks. I think that's a nice place to end. Back to General Sanders' point about agency. All these countries are member states and, are part of this club and following these rules, but actually doesn't mean to say that you still, as governments and institutions, you still don't have quite a lot of agency and scope to, there's certain things that are within your control to actually do something with the stroke of a pen even to change legislation and so on. So yeah, I think agency, I'm all for it, and we need more of it, I think, in the EU. So thank you very much indeed. That's all we've got time for. We've got an energy session now. Please join me in thanking our speakers.
Thank you.